Hello and welcome to the paid weekly recap for the week ending December 5th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind predictive AI for dynamic market system. Normal disclosures before we get started: options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. I urge you to check out this link at Options Clearing to learn more about the characteristics and risks of standardized options. And if you do have need more time with the disclosures, please go ahead and pause the video here. Otherwise, we'll get into the recap for this past week. First things first, we have the 10-year yield, which has been rising during the week. Early in the week, we had a little bit of a pullback followed by a rise. We've generally been pinned to 4.1%, sometimes getting a little bit lower, down near 4% last week. Sometimes we get close to 4.2%, but we always seem to return to that 4.1% level. That seems to be our natural target. And while we've seen a lot of rotation within the market, there's no driver from the interest rate side of things to really do so. So at this current point, just looking at this 10-year yield as being very stable, not really concerning, giving a lot of concern on economic growth, nor on inflation or anything else. And overall, a bit of a disinteresting chart for now. And maybe we'll see it break out of a range and start to shift both sector focus as well as economic projections for the United States. Speaking of rotation within this market, we've been seeing a very sideways market. Now, Friday, we did look to break out of this recent range and press towards highs. We got above the high from mid-November. We did not make a new all-time high yet. Very tight range overall, as there's been more sector rotation rather than broad market bullishness or broad market bearishness for the last week or so. So overall, the market is positioned to potentially go higher as we go into the traditional Santa Claus Rally timing, where December is often a bullish market. Now, that said, we do have a Fed announcement this upcoming week, and we have non-farm payrolls the following week. So there are some inputs that could shift market tone going into the end of the year. Tech has been somewhat underperforming in terms that it's not pressing quite as close to the all-time high. But generally speaking, tech has continued to follow along with the market. Now, oftentimes when we see a true bull market, tech leads, growth leads. So seeing tech kind of in line with the market with some chop in there, on Thursday, tech was actually down a little bit instead of the market being up a little bit from the open, is not necessarily concerning, but it's not giving us signs that the market's really attaching itself to a risk-on bull market yet. Small caps also pressing towards highs and closer to the all-time highs after a big dip of a couple of weeks ago, pressing below the 100-day moving average, and then recovering very well last week and then in the past week as well. Overall, small caps do look like they will be first to break out to a new all-time high if this is going to occur for the market, with tech lagging and the broad market lagging as well. But right now, small caps widely driven by things like healthcare, which has been very bullish, but not this past week. Financials, energies, some other sectors that have been less loved over the last year or longer. And then finally, we have the VIX, and the VIX is also driving down, showing a lack of fear into the end of the year. Now, oftentimes you have sort of a self-fulfilling or repeated process, like a spiraling effect, whereas the VIX goes down and fear goes down, the market goes up, which causes the VIX to go down, which causes the market to go up. And we seem to be getting into a little bit of that trade-off now after the spike near 30% a couple of weeks ago when we were testing lows. Overall, it looks as if investors are just positioning for a fairly dull December, unless the Fed or non-farm payrolls can spook that. But at this time, it appears that we are positioning for that further upside run, grind higher type behavior into the end of the year. Now, all that said, we did have one trade this week, and we went with Broadcom, AVGO. Now, to start the week, it was a bit weak. Held off on Monday and ended up entering the trade on Tuesday near the lows of the day. We were holding around 380, 382 and a half was seeming to hold. We were trading around 384. Previous high was 386, and we had some highs at around the 380 level. Looked like all of that was going to hold, and we actually did dip below it on Wednesday before a recovery into the end of the week. particularly bullish day on Friday as money flow started to get back into tech. And I apologize, this should say 382.5, 380, not 182.5, 180, but we did end up looking at the stock from the open on Tuesday until the close on Friday being up about a 0.5%. Now, the 382.5, 380 put credit spread that expired on Friday ended up going out worth zero. Given the market move and everything else, we looked at a close at a nickel a couple of hours before the closing bell. After an initial entry at a 95-cent credit, exited a nickel. That ends up being about a 58% gain over the 3 days. So a very strong performance, good trade for us for this week. That's return on risk. So there's about $1.55 of risk for a 95-cent credit initially. Solid week for paid. The new put credit spread opportunities have certainly been lining up well, and we've been happy with that shift overall in the initial trade entry. Oftentimes, we would look at AVGO on Wednesday and utilize that dip to potentially add a call. The problem with AVGO is that the calls were very expensive because they do have earnings in the upcoming week. So because the price was high, couldn't add the extra leverage to potential move that would have had an additional 50% gain. But at the end of the day, quite happy with the 58% gain for the put credit spread, and we'll look for new opportunities in the coming week. If you'd like to join us as well, make sure you're checking out the live trading room. Continue to see strong performance. We've got new ideas coming in every day, earnings-based ideas, as well as other technical signals and AI-generated signals. So always happy to chat about markets, what's driving the market, what sectors are seeing money flow, and opportunities that you may be starting to evaluate and you want the viewpoint of myself and or Vlad. Remember, we're on from 9:15 till 10:15, 10:30 Eastern time in the morning, and the closing bell from 3 to 4. And happy to discuss any ideas or questions that you may have. And if you can't join us in the live trading room or you want to talk to us outside of that space, you can always email us. I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Thanks again, everyone, and looking forward to another interesting week, particularly with the Fed announcement on Wednesday. Thanks again.